Nokia stock is currently trading at $14.80 per share, reflecting a powerful intraday surge of 5.04% during this active trading session on the New York Stock Exchange. While most everyday market participants still view this company as a dusty telecom hardware provider left behind by the mobile phone evolution, institutional whales are aggressively buying the equity under the radar. JP Morgan just drastically raised its target to $21, while CFRA pushed theirs to $22, signaling a massive structural gap between what retail investors believe this company is and what its balance sheet is actually transforming into. Over the last year, the equity has rocketed over 170%, driven by an explosion in high-margin cloud infrastructure and advanced hardware manufacturing that completely defies the general public perception of a stagnant legacy brand. The common ground shared by the vast majority of retail investors using popular retail trading apps like Robinhood or engaging in self-investing across various investing sites is that Nokia is a low-growth, low-margin cyclical play tied exclusively to global telecom carrier budgets. People look at the historical multi-year charts on their Fidelity mobile app or tracking accounts and assume the company is a permanent value trap trapped in the single digits. The contrarian reality, however, is that Nokia has quietly established an almost impenetrable moat in the optical networking and proprietary chip fabrication space. This hidden asset is now capturing massive infrastructure allocations from hyperscale cloud data centers. When major investment funds utilize an individual brokerage or tools like Schwab Intelligent Portfolios to reallocate capital into the data network layer, they are increasingly finding that this European giant holds the physical manufacturing capacity that American tech giants desperately require to build out next-generation data architecture. If you open up the Interactive Brokers trading platform or analyze institutional order flows on a Fidelity brokerage account, you will notice a staggering amount of volume shifting into Nokia over the past 48 hours. The primary catalyst for this massive daily swing is the sudden realization that the firm controls its own proprietary indium phosphide fabrication facilities. In an environment where semiconductor supply chains are constantly under geopolitical stress, owning a physical, specialized foundry that produces advanced optical components is the ultimate luxury. This hardware allows data centers to transmit information at speeds that traditional copper wire or standard fiber optics cannot handle. Major cloud hyperscalers are running into a physical wall, where processing power is outstripping data transmission speeds, and they are writing billion-euro checks to Nokia to bridge that exact gap. This structural advantage drove more than 1 billion euros in fresh cloud-adjacent orders in the first quarter of 2026 alone, throwing a massive wrench into the short thesis that had kept the equity pinned down for years. The tension between expectation and reality is vivid when looking at the network infrastructure division, which senior management recently upgraded for its 2026 growth outlook. Casual investors logging into their online investment portals expected a severe slowdown due to sluggish global 5G rollouts, which did heavily dent the company's mobile networks division. But the reality is that the hypergrowth in optical networks is completely overwhelming those legacy weaknesses. It is a textbook lesson in why online investing requires you to look past the front page news and analyze segment-by-segment performance. While the retail crowd was panicking over carriers cutting back on cell tower equipment, sophisticated funds using the Interactive Brokers platform were looking at a 49% year-over-year surge in cloud customer revenue. This structural divergence creates an incredible mispricing that the market is only now beginning to correct, causing the massive price target increases we are seeing from major investment banks. Technically, the stock is showing an incredibly healthy consolidation pattern inside a powerful long-term uptrend, supported by a classic golden cross technical pattern that formed late last year. Even with the recent single-day surge, the relative strength index sits right around 49.81, which tells us the equity is neither overbought nor exhausted from a technical standpoint. In plain terms, an RSI at this level means the stock has plenty of runway to absorb new buying pressure before it becomes fundamentally overheated. For those handling their own accounts through self-investing or setting up automated allocations via an intelligent portfolio, finding an equity that has rallied over 100% year-to-date but still possesses neutral momentum indicators is an incredibly rare setup. It indicates that the recent rally is backed by institutional accumulation rather than speculative retail hype, which provides a much sturdier floor during periods of broader macroeconomic volatility. Let us pause for a second and get a pulse on what you guys are doing with this asset. Comment below how many shares of Nokia stock you currently hold in your portfolio and whether you are buying this recent breakout or waiting for a deeper pullback. Seeing how real traders are positioning themselves across different platforms gives everyone a better read on market sentiment. To truly understand why the institutional money is moving the way it is, we need to analyze what this business actually does today versus its historical business model. Nokia operates primarily through 4 core segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies, which manages their massive patent portfolio. The business model centers on selling high-performance hardware, software, and managed services to telecom operators and large enterprises. Over the past decade, the company went through a painful restructuring phase, selling off its mobile device division and focusing entirely on the underlying plumbing of the internet. Their older reports from a few years ago paint a picture of a company struggling with intense price competition from overseas rivals and low-margin contracts that eroded profitability. That historical performance is exactly why the stock traded like a penny stock for so long, creating a deep-seated bias among retail investors that is only now being systematically dismantled by their current financial performance. The new reality is that the firm is aggressively stacking software layers on top of its physical hardware. They recently introduced an agentic artificial intelligence framework for their network services platform, aiming for full commercial availability by the end of 2026. This software automates complex IP network operations, drastically reducing troubleshooting times for large network operators and providing an incredibly high-margin recurring revenue stream. When you combine this software push with physical expansions, like their massive 5G modernization contract in Indonesia to cover 80% of the mid-band network over the next 3.5 years, you start to see a company that is successfully playing both defense and offense. This is exactly the kind of deep operational pivot that sophisticated platforms like Fidelity Wealth Management or specialized institutional desks look for when selecting long-term turnaround plays for large-scale portfolios. Looking ahead, the future outlook for the company will be defined by how effectively they navigate several key catalysts and risks. The biggest opportunity lies in the continued acceleration of data center buildouts through 2026 and 2027, where their proprietary component manufacturing gives them a distinct pricing power advantage over competitors who rely entirely on third-party foundries. However, the risk side of the equation cannot be ignored. The mobile networks division remains highly exposed to cyclical spending slowdowns by global telecom carriers, and if macroeconomic pressures cause these corporations to defer their infrastructure spending further, it will create a significant drag on Nokia'S consolidated earnings. Investors managing their individual brokerage allocations or purchasing Fidelity ETFs and Fidelity mutual funds that hold international telecom exposure must carefully weigh whether the hypergrowth in optical networking can permanently outpace the cyclical stagnation of traditional mobile tower hardware. When we synthesize this entire landscape, the contrast between market expectations and operational reality becomes the core investment thesis. The market expected a tired, cyclical hardware vendor struggling to maintain single-digit margins in a saturated telecom market. The reality is a vertically integrated infrastructure powerhouse that owns crucial fabrication capacity, logs billion-euro cloud order blocks, and is successfully introducing high-margin automation software to secure global IP networks. This massive gap in perception is why the stock is experiencing intense volatility and high trading volume as institutional capital reprices the asset toward the higher targets set by major research desks. For anyone engaged in self-investing, tracking this divergence between public narrative and corporate execution is precisely how you find true value before the broader market completely catches on. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. BINL. Don't forget to like, comment, and share this video to support the channel.